Okay, first of all, I want to welcome everybody back. This is a program funded by the Fund for Veterans Assistance by the TVC, the Texas Veterans Commission. Our mission is to provide comprehensive training for individuals seeking to create, sustain, and expand businesses, increasing their chances for long-term business success. The partners that we have are the SBA, the Texas Veterans Commission, the University of Texas Pan American, Small Business Development Centers, military transition offices, veteran organizations, and other nonprofits. Today we're going to talk about roles of the business owner. In this presentation, basically our objectives are to describe the resources an owner manages in small business, explain resource-based strategic planning and niche market identification, and inform some of the different business services available to small businesses. These are the basic responsibilities of a small business owner. They serve as a personnel manager, accounting, sales, marketing and advertising, legal issues, technology, receptionist and a clerk, and they deal with strategic business planning. This is some of the tools that are available to managers out there. The Society of Human Resource Management deals with personnel manager, and if you go to this website, you'll see that they have templates for a lot of issues that deal with HR. So it's a very good site. They talk about how to hire somebody, how to keep records, personnel records, how to let somebody go. Accounting, one of the software packages that we talk about are QuickBooks. It's a very good package. It helps you do a lot of things. You don't have to be very knowledgeable about accounting. Salesforce, it helps a business with the sales. Marketing and advertising, Google AdWords. I don't know how many of y'all have ever used Google AdWords. Basically, it's kind of like a pay-as-you-go. Like once a person clicks on it, then you get charged for it, and you can set up limits on how much that you're going to pay on AdWords. You may set a limit saying I'm not going to pay more than $25. So that's how much you're going to pay a month. For legal issues, LegalZoom.com is a good place to go to. Here they charge for the forms, but it's good, it's cheap legal advice. For technology, there's Microsoft 365. For receptionists, there's ConstantLink.com. I went to this website. It's a very good website. I suggest for people, when I had my own business at one time, I hired a person to answer the phones and be our receptionist. It would have been a lot cheaper if I would have used this ConstantLink.com. There's many other organizations out there like this. This is just one. What it is a person doesn't have to be in your office, but you're given a dedicated phone line. And when a customer calls into that phone line, they have a bunch of receptionists that will answer the phone and say, well, so-and-so is busy. Let me see if he can take your call. And then they'll call you, and if you say, yes, I want to take the call, they'll transfer the call to your phone. Or if you say, no, I'm busy, they'll say something like, well, he's in a meeting right now, Strategic business planning. This is a good first step. The entrepreneurship training program, Vboc, talk to the counselors, use myself and Carlos as a resource, and there's also the Small Business Development Council. And like I said, if you talk to me or Carlos, the resources that we use and to talk to us, it's free. We're never going to charge you for it. So. Okay, in groups of 2 or 3, which we're not going to get into groups, identify which roles of business owners are you strongest at and which ones will you need help with. And I'm going to go back here. I can tell you that on all 8 of these, one person, it's very rare to find one person that has strength in all 8. I can tell you that I was very good at personnel management. I'm real good at accounting. I'm not very good at sales. I'm not very good at marketing. I'm very good at legal. And I'm very good at technology. And some people are good at being a receptionist and some people aren't. So you need to take all those things into consideration. You need to sit back and take note of yourself. What are you good at? What aren't you good at? This what I'm telling you is just what I'm good at. So take into account each one and decide which one you're good at. Basically, these are the 4 parts or resources that managers manage in a small business: the human resource, physical resources, financial resources, and information resources. And basically, this is them divided up into all 4 groups and who takes charge of them. Usually in human resources, you have a COO, which is a chief operating officer. Your physical resources are also in operations. It's controlled by the chief operating officer. Your financial resources are controlled by your chief financial officer. And your informational resources are usually controlled by your chief information officer. And right here you can see where are you as a small business owner. You're the CEO, and where you should be is in the middle. So basically, you need to take all 4 into account. There used to be an ad on TV, and I liked the ad. It was for a furniture store in Westlaco. And the guy would say, well, not only am I the owner, but I'm also the manager and the janitor. And basically, when you own your own small business, that's what you are. You are in charge of all 4 parts. So let's talk about human resources. The biggest management activity is to interview and hire. You also have employee training and development, operations implementation, which is like schedules. When are you going to work? Are you going to be open from 8 to 5, Monday through Friday? Well, if you're going to open up at 8, you're probably going to have somebody there by 7:30 who's going to unlock the doors. So you have to take that into consideration. So when you schedule personnel, then you know, well, I have to schedule somebody there at 7:30 because we're going to open the doors at 8. Or are you going to work Saturday or Sunday? You also have to evaluate your personnel, which is also goes hand in hand with promotion and compensation for them. And you also have to deal with employee termination. And that's a tough one. I've never had to terminate somebody, but a lot of companies nowadays are downsizing, so they are having to let people go. So we talk here about management theory, theory X versus theory Y. And theory X basically states that the manager looks at the employee as being lazy, unmotivated, and needs to be micromanaged because they don't want to be there at work. Theory Y looks at the other way. It says, well, a person is self-motivated, very ambitious. They want to be at work. They want to gain ground on people. The truth is, the situational leadership, you kind of have to look at both. You have to determine, well, some employees do want to be there, and some employees really don't want to be there. So, as the COO in charge of human resources, one of the questions that you want to ask yourself is, what positions do you have to fill? What qualifications are required? And this goes back into education and experience. Let's say you start a service company for air conditioner and refrigeration, right? Well, you want to make sure that the person you employ knows about air conditioners, knows about refrigeration. Are they certified? We talked last time about having to have a license to deal with that. Are they licensed? Are you looking to hire an apprentice? Maybe you're looking for somebody who has to do work hours in order to get that license, things like that. Some of the tools that you're going to use for figuring out who to hire is job descriptions and also employee handbooks. Resources to use is TWC, which is the Texas Workforce Commission. There's one located here locally. They're located in various places throughout the state of Texas. The Society of Human Resource Management, and I told you that they have a lot of good information on there. You want to utilize attorneys, and like I said, you want to make an appointment to talk to Carlos or myself at the Vboc or an SBDC. Just give you a brief story. I had a person who was going to start a business, and they were like, well, where do I need to go to hire employees? I said, well, the first place I would go is the Texas Workforce Commission, because almost everybody goes there to register. Another place is advertising in the local paper under employment. Let people know that you have a job out there. So, fiscal resources. This also falls under operations. And as a small business owner, you're going to have to deal with this. It's also known as the COO's job. Basically, it's like what and how you use or manage your physical assets. And a lot of this is like building, land, equipment. Think about making money. What's your return on investment? Lots of times, it's a lot better to rent or lease equipment than it is to buy equipment. Basically, when we talk about physical resources, we talk about plant or equipment, and we talk about like the building. A lot of places don't need to buy a building. A lot of places just need to rent a space inside a building. So you don't want to really own it. You always want to look at location and outsource or make it in-house. Are you going to outsource a product so that you don't need the equipment, or are you going to make it in-house? Those are things that you have to consider. Other question, what things do you need to sell your product or service? How do I make sure that I am taking care of these resources? This goes back into what do you need to make your product, your end product, the one that you're going to sell? Are you maintaining it? Are you taking care of it to make sure that you extend its useful life? You could buy a piece of equipment and it might have a useful life of 5 years, but if you totally mistreat it, maybe it's only going to last 3 years. So you need to take care of it. Tools that physical resource managers use are operations manuals, SOPs, standard operating procedures, maintenance, have a list of equipment so that it doesn't just grow legs and walk off on you. Some resources that are available to you are industry associations, private consultants, and suppliers. Next, we're going to talk about financial resources. And this is broken down into two categories. For startups, you need to know where you're going to get the capital, which we're going to discuss in another module, and what are your working capital needs. I was talking to a gentleman just the other day who was talking about, well, if I have a supplier or if I sell a product to somebody but I don't get paid for 3 months from the day he buys it, what that's going to hurt me for the 3 months I don't have cash. And I told him, well, what you want to build into your business plan is usually about 6 months worth of working capital, so that you can operate even if you don't have any income coming in. You have enough working capital to last you 6 months. So for existing businesses, part of the consideration that you want to take is increase in sales. You want to lower costs, and we also deal with a combination of both. Maybe you want to increase sales and lower costs. So those are some of the responsibilities of the CFO which as a small business owner, you're going to be responsible for this, at least if you want to stay in business. So one of the questions that you want to ask yourself is, do I have the financial resources required for my business to operate efficiently to meet my strategic goals? So this is one of the questions that you want to ask yourself. Do I know my business is performing in financial terms? And how much capital is needed for this business in the future, and do I know what will require to get it? And we'll talk a little bit later about like a financial gap. And a financial gap is, say that you buy a product. Well, there's a little bit of time between when you purchase a product, when you have to pay for the product, and a lot of this is on credit. Is when you get the product, when you pay for the product, and when you sell the product. The other thing you have to look at is when you get the product versus when you sell the product versus when you get paid. There's usually a gap in there. And you need to have enough funds to cover that time when the cash is going out and it's not coming back in. And that's what working capital will do. Some of the tools for financial management is accounting systems. The QB stands for QuickBooks. Monthly or quarterly budgeting and review. Annual projections and comparisons, and ratios. And we'll get more into that a little bit later this afternoon. Some of the resources that you'll utilize are CPAs, the SBDC or the Vboc, QuickBooks, and RMA. And basically what RMA is it's a book that we use, and it shows you all the industry trends. So it's basically broken down into industry. Next, we're going to talk about the CIO, the information resources. And basically the CIO deals with patents, copyrights, trademarks, and trade secrets. They utilize systems, technology like the management information system or a computer information system. So one of the questions that you want to ask yourself is, do I have all the necessary knowledge in order to manage the business in the most appropriate way to meet strategic goals? And an underlying knowledge here, because I don't think that a person can ever have too much knowledge. I think a knowledge on how the business operates, how the industry operates, how the industry trends, things like that is very important to know. What your customer thinks is very important to know. So any kind of knowledge that you can get is a benefit to you. And the CIO is in charge of this, but you as a small business person, you're going to be in charge of knowing all the knowledge, all the information. Can I communicate this information easily? You're going to want to maybe you need to tell your salesperson, maybe you need to tell the person in charge of inventory that you need to buy more product. Maybe your product is seasonal. And do you have a means to store key information and plan in case of an emergency? I know that down here we have to deal with like hurricanes. And so you have to make sure that information is backed up so that it can be recovered easily. Some places they have earthquakes. Just recently they had the terrorist attack in New York. Well, 9/11, right? Well, not recently, but that was one of my questions. It's like they pretty much destroyed that whole building. And so what about the companies that had offices inside that building? Did all that information just get destroyed? No, they had backup plans where they backed it up in different places so that they could readily retrieve it. Other tools that information people can use are operations manuals, computer systems, filing systems, and market research. Some of the resources are the cloud service. I can tell you, I told y'all earlier that one of my strong points was technology. This is one that I'm not very strong about. I ask questions all the time. Well, what is the cloud? I don't really know. Who owns the cloud? Things like that. And some of y'all It could be second knowledge, whatever the cloud is. So basically, we're putting it all together. What resources are most essential to your business? And, every business is a little bit different, So it's very important. If you are a retailer, you may not have a whole lot of physical resources, But then again, you have like racks that you have to have. You have to have lease a building, things like that. So to me, financial resources is something that everybody needs to know. It's very essential that you take this information and use it to the best of your ability. You need to ask, what are your strengths and weaknesses in managing your business resources? Like I explained to y'all, it's very important that you look at those 8 things and try to figure out, well, what am I good at? What are my weaknesses? And like here it says, fill in the gaps. If you do have a weakness, hire employees or contract people to address weaknesses. You don't have to know it all. You don't have to do it all yourself. You can hire people that do know that kind of stuff, or can address that. Like, I know we'll talk a little bit later about accounting. And I know there's some people that are very good at accounting, and there's some people that aren't very good at accounting. Lots of times that's a weakness. So lots of times what they'll do is they'll hire an accountant that'll look over their books, a CPA that'll look over their books, someone like that. So, and also it's real important that when you do have a weakness, get yourself some training and some support. I was a mortgage broker. I knew nothing about mortgages. I learned it all. I had to go to a bunch of trainings. Now, you ask me, I know quite a bit. So, okay, in summary, we need to understand the various roles of business owners. You need to ask the right questions, and you need to know what tools and resources are available to you. So, are there any questions? Okay, thank y'all very much. Okay, the next section that we're going to cover is business budgeting and bookkeeping. I like to look at bookkeeping as more like record keeping. So, some objectives is to determine the functions of record keeping and who is responsible, and to review and outline federal and state record keeping requirements. So basically, the functions of record keeping are to monitor the progress of the business, identify sources of receipts, keep track of deductible expenses, prepare financial statements, prepare and support your tax returns, and there's also other reasons that you may use record keeping to apply for a loan, maybe if you're bidding on a job, or maybe if you're requesting bonding. So just a brief overview of budgets and bookkeeping. It's to generate additional sources of capital through partnership and investment. And we'll discuss undercapitalization a little bit later. Use it for compliance with payroll tax protocols, and use it for submission of sales tax, which are paid monthly or quarterly, depending on how large it is. Additional functions of bookkeeping may be to distribute profits to partners, or dividends to people that own a corporation, the stockholders. And right here, we're going to talk about a little coffee break discussion. We're not really going to break up into groups, but it says identify at least one bookkeeping software program. We kind of already talked about that. QuickBooks, I think it's a very good program. It's very user-friendly. And, it does have some pros and cons. And the pros are it's user-friendly, and one of the cons is you really have to know it. Like I said, I had to take the QuickBooks class just to write a check. But once you know it, you know it. And it's very good. It helps you control inventory, money going out, money coming in, things like that. And just quickly, think about the use of Excel, the Excel spreadsheet. It's part of the Microsoft Office. How many people are real good with that? It's real important that you know a little bit about Excel. It's not mandatory, but it would help. So, some of the responsibilities for record keeping. Right here it says, although responsibilities can be delegated to an employee, the owner should be aware and involved. And this is for any kind of record keeping. And the business owner is responsible for conducting a thorough investigation of all business transactions. Here, I want to stop. And it's real important that you understand, as the business owner, you're not only responsible, you are the person that everybody's going to go to. It's your job, it's your responsibility if you default on a loan, that you know that you're responsible for the record keeping. You may delegate it to an employee, but you're ultimately responsible for it. So, these responsibilities can be delegated to a professional for a fee, bookkeepers, tax preparers, accountants, CPAs. But it's real important that even if you do outsource it and you hire one of these people, you're still ultimately responsible for whatever record keeping your business does. So, the items to keep and record: sales and revenue transactions, cash transactions. It's real important to keep track of sales transactions. This is one of the biggest places where fraud occurs. People have seen it in the movies. I know you have heard of just skimming the till. A cashier maybe just puts $20 on the side and doesn't put it in the cash register. So it's real important that you do understand cash transactions, that you keep them recorded and you keep them straight. Accounts receivable. Basic accounts receivable is when you sell product on credit, and it's real important that you know how much money somebody owes you so that you can collect that amount. How much have they paid you? Accounts payable, it's when you owe somebody, like a supplier, a utility company. Some companies, they'll buy their product from a supplier, on credit. And so it's real important that you realize what products you've got, how much you owe them. It's something that you need to know. And basically, summaries of transactions. Record types, the business budget. This is something that most companies do utilize. It's real important that you have a budget. You know how much you expect to take in, how much you expect to spend, things like that. Another statement is the income statement or the profit and loss statement. This deals more with operations, the day-to-day operations of the company. How are you making money? Are you losing money? Things like that. Balance sheet or the statement of financial position. This is also something that you want to keep track of. Basically, your balance sheet deals with your assets, your liabilities, and your owner's equity. The income statement deals more with accounts, and the balance sheet deals more with the balance of accounts. So the other statement that you want to look at is the cash flow statement. This is how much money is going out of your company and how much money is coming back into your company. It's very important that you know this information. The day books, here we call it day books. Another term for it is journal entries. Basically, you have all kinds of different journals, and they deal with the daily transactions involving sales on credit, purchases, purchase credits, and cash. You also have petty cash that you're going to keep around the office that, maybe just to buy coffee for the employees or a gift for someone. And your ledgers are generally your purchase ledger and your general ledger. I think it's real important here to understand the difference between a ledger and a day book or journal. And the journal deals with your daily transactions. Your ledger deals more with like a balance. Like if you're going to buy something, say you're going to buy supplies, you know, you're going to say cash going out and supplies coming in, right? And that's more of a journal entry. But you're going to have a whole page just dedicated to nothing but cash. And you're going to say on your ledger, you're going to have cash goes out, cash comes in. And you're going to have to turn to a totally different page, and it's going to have your inventory, and it's going to say inventory came in, inventory goes out, things like that. So some important abbreviations used in accounting and bookkeeping. I'd like to point out the first 5. The B/S stands for balance sheet. The DR stands for debit. CR stands for credit. The G/L stands for your general ledger. Your PP&E stands for your property, plant, and equipment. So these are all very important abbreviations to kind of know that you may see or may be used in the record keeping daily. So some of the federal and state record keeping requirements. We all know about the IRS. Income tax returns. Income tax returns need to be kept for 7 years. And this is a federal law. So basically your income tax return, your W-2, your 1099s, you need to be aware of all those things. DOL, your Department of Labor, deals with your wage and hour, the youth laws, and the OSHA laws. And they can go back 3 years, so you need to keep your records for at least 3 years. The Texas Workers' Compensation Commission, basically, and we'll talk a little bit more about that later, your unemployment taxes that you're going to pay your employees that go on their check. And they can go back 3 years, so you need to keep your records for 3 years. Other agencies that you need to keep records for is the TABC if you're going to sell alcohol. The comptroller, it deals with the sales tax, corporate tax, things like that. And DHS for daycares, home health centers, and durable medical equipment. This is important to know. It's that you don't need to know accounting, but know that you are responsible for it. Accounting is a very technical system about how to record things. So, but you don't need to know that, but you do need to have a good idea because you are responsible for it. You're going to be expected to keep track of your business's financial information, and you can do it either way by doing it manually yourself or through software, or hire someone to do it or outsource it. Bookkeeping versus accounting. Like I said, bookkeeping is basically record keeping. You have to know your financial situation, things like that. Accounting is a system of gathering financial information about a business. And basically the 6 major duties of an accountant is to analyze the information, to record the information, to classify the information, to summarize it, put it all together, report the information. Basically, it's telling others the information that's out there, and sometimes this could be as much as doing it for the reporting to the IRS. Like I said, keeping the evidence for the IRS to back up your tax return. And also, I think this is very key, interpreting the data. And this explains, well, you know, is this going to be is this something that's good for the company, or is this something that's bad for the company? You know, does the industry see that? Do they do it the same way, or is it just us? So, some basic accounting terms that you need to know. And basically all types of accounting are broken down into 5 different groups. You have assets, you have liabilities, you have equity. On your income statement, you have revenue and expenses. So basically, this is kind of the accounting equation. And it's like resources equal claims. Your resources are your assets. It's the total value of your company. It equals liabilities, what outside people have claims against your company. Like, do I owe the supplier? Do I owe utilities? Do I have a note, that the bank has? And whatever's left after that is equity. So this is basically a single entry bookkeeping system. If you have just a small company, maybe you're just a small one-person lawn care company, you might do something like a single entry bookkeeping. And that this is a lot like a checkbook, where you just record, what you got coming in and what you got going out. And this is what they call double entry bookkeeping. And basically, you can see here there's debits and there's credits. And so basically, for every transaction that you're going to have another transaction, it's going to involve another account. Like it's very simplistic, but let's use the supply one. You buy supplies, you've got cash going out, you have supplies coming in. So something simple like that, that's a double entry bookkeeping. So are there any questions about that?
So you're accounting for that supply as an asset to your company?
Right. That supply would be an asset, and you're giving up another asset, which is cash. You can do stuff like that with liabilities also. You're getting something for something else. So it's double, you're counting both of them. Where if you mow a lawn, you may say, well, I have $20 coming in. And you may later on the week, you say, well, I got to fill up my lawnmower with gas. I got $20 going out. That's single entry. Double would be like, well, basically for everything that's coming in, there's also something going out. So, any other questions? Some of the resources to use is irs.gov, dol.gov, which is Department of Labor, twc.state.texas.us, which is the Texas Workforce Commission. TABC's website's on there. Allbusiness.com is a good resource to use. The Business Dictionary is a good one to use. Wikipedia kind of breaks down and lets you know what each part of the accounting equations, what it stands for. And there's also bookkeeper.net. So in summary, there is an importance to record keeping. Remember that as a business owner, you're ultimately responsible for all record keeping. We talked about what items to keep. It's real important. One of the main ones to keep a log on is cash transactions, because it's so easy for cash to disappear. And we talked about basics of bookkeeping. Okay, next we're going to talk about pricing. I know this is something that everybody kind of wants to know. Is like, well, how much do I price my product for? And in this module, we're going to talk about basic pricing principles for small businesses. We're going to explain the processes to follow to help determine the right price for your product or service. And we're going to inform on common pricing mistakes. So this is basically a model that was put together on pricing. And as you can look at it, you can see, go toward the right side. When it comes to pricing a product, pricing covers business input and profit margins. Here, the simplest way to look at this is how much does it cost you to build that product. If that product costs you 70 cents to make, then you need to price it over 70 cents. Now let's say you want to make a profit margin of 30 cents. So you're going to price it at $1. Basically 70 cents is what it's going to cost you to make it. 30 cents is what you're expecting to make as a profit. That's what you're going to price it at. And then you go toward the bottom. Of course, this product is going to be evaluated by your customer or your service client. They're going to say, is it worth me paying $1 for it? Is it good quality? Or can I get it somewhere else? And if you go to the left side of the model, the pricing of competitors' products and services, this is kind of the other way to look at it. Well, what is my competitor charging for the same product? Are they charging $1 for it? Are they charging 80 cents for it? If they're charging 80 cents for it, maybe I need to come down to match their price down to 80 cents, which means, it's going to cost me 70 cents to produce it, but my profit margin is only going to be 10 cents. That's another way. And it goes back down to the bottom. The customer is going to look at it and perceive its quality. Which one's better? Which one's a better price for me to obtain? So that's the two general ways that you price your product. You look at what it costs for you to make, plus your profit margin, or you look at what the competitor is selling it for. Price mechanisms are designed to increase profits despite changing market conditions and consumer expectations. Examples of price mechanisms. Do you want to be the loss leader? And we kind of talk about this later. Basically, the loss leader, you're not going to be in business for very much longer. This is a person who's selling their product at less than what it costs for them to make it. What's the price-quality relationship? A good example might be like a Cadillac. It's high quality, but it's a high price. It's more like a luxury item. It's going to have premium pricing. I know a lot of people will go and only buy stuff that's made in the USA, but they'll pay a premium for it. It's a lot more expensive to buy something made in the USA than it is to buy something made in China. But it goes back into what's the quality. You probably have a better quality from something made in the USA than in China. So, demand-based pricing. Is there a demand for your product? Maybe you have a coffee shop and you can only serve 10,000 cups of coffee a day, but the demand is for $15,000. Well, maybe you can charge a premium for your cup of coffee and bring the demand back down to 10,000. So, and multi-dimensional pricing, just different ways, all these different strategies. We use an example here of a car. It's like you may be required to make a down payment and then make a monthly payment. So, non-price factors allow an entrepreneur or business owner to beat the price competition. Some stuff to look at is travel time. We just got through talking about a cup of coffee. You may be willing to pay $2 for a cup of coffee, but it's only 2 miles away from your house. Maybe the local store has got the same cup of coffee for $1, which is much less, but you've got to travel 10 miles to go save $1. And so it kind of goes back into as a customer, is it worth it? Is the quality that much better? Or are you going to save $1 by not driving the extra 8 miles? Gas is pretty expensive nowadays, so, wait time. I like to equate this to like McDonald's and a Whataburger. Sometimes you go to McDonald's, you spend like a minute there. Sometimes you go to Whataburger, you spend like 10 minutes there. Is it worth your time? Product quality. These are all things that people are going to look at. The customer's going to perceive, is it there or not? Product quality. Is your quality better than somebody else's? Customer service. Is your customer service better than somebody else's? Or is theirs better than yours? and convenience and ambiance. I mean, there's places that I go to just for the ambiance. I know that if I go there, nobody's going to bother me, which is nice, because I like it that way. But maybe you want to go to a dance club and you know it's going to be packed. So, okay, this is an activity. Like I said, we're not going to get into groups. Basically, we're going to determine the price for a business that we're going to start up. Here, a business that we're going to start up is selling gelato, which is Italian ice cream. And we're going to sell it by the cone in 2 sizes, small and large. And customers love your samples. It costs you $2 to produce a small cone and $3 for large. Your competitor charges $4 for a small cone and $6 for a large cone. The ice cream shop, which is a substitute, because it's not gelato, it's just ice cream, is selling the small cone at $3 and a large one at $4. The Raspa stand just down the street is selling their small for $2 and their large for $3. So looking at those situations, what would you charge? And looking at those, what I would charge is you want to make a profit, so it costs you $2 to make a small cone. So you're probably going to charge around, say, $3.50, because for a small cone, your competitor charges $4, so you're cheaper than your competitor. Your substitute is charging $3. You're a little bit more expensive than your competitor who has a substitute product, but your product is also better quality than he has. And the Raspa stand is selling it for $2, which kind of blows you away. But I mean, if you want gelato or ice cream, Raspa is not going to cut it. So it's something totally different. So you would look at things like that. So 9 laws of price sensitivity and customer behavior. Basically, the framing effect would go back to like if you go to Whataburger, lots of times you buy like a combo, and it goes back into what Carlos was saying the other day. It's like it probably costs them more to make a burger and fries than it does to make the drink. There's a higher price that you're going to pay for the drink. But like I've gone to like a Whataburger before, and I bought just the burger. And usually what it costs to buy a burger is the same price that it would cost to buy combo. So customers look into that framing effect. The fairness effect. What is the fair market value of the price that you have? Are you in the same market as your competitors? You go back to the burger example. You might be willing to pay $5 for a burger, but you're not willing to pay $10 for a burger. So if Whataburger all of a sudden came out with, well, now we're charging $10 for our burgers, people are going to stop going to Whataburger. The shared cost effect. Can I order steak and dessert because the company's paying for it? Is somebody else helping you pay for it? These are things that customers consider when they look into their pricing thing. Is somebody else going to help me pay for it? Do I have to pay for it all myself? End benefit effect. Is this product going to restore my youthfulness? And, it's something that you need to look at. It's something that you really want. So you look at the end benefit, more than the immediate effect. The expenditure effect. What percentage of my budget will go toward this product? And you may say, well, I have a fixed budget. I make $2,000 a month. That's what I make. And this product costs $500. Well, you can say, oh, well, that's too expensive. That's going to be 25% of my total budget for the month. It's like they take that into consideration. Price quality effect, and we've kind of been talking about this. And the example here is the Honda model is reliable. The one thing you can say about, like, say, the Honda Accord, those things last forever. They're very reliable. So that's something. It's like, well, is the quality of what I'm going to buy worth what I'm going to pay for it? Switching cost effect. Is it going to be more expensive if I change suppliers? And this is more that you're going to look at as a business owner. If I have to change my supplier, is he going to charge more for the same product that I already have? How's that going to affect me? A difficult comparison effect. The surgeon that I want to use has a great reputation, but he's very expensive. I don't know about y'all, but I don't want to skip on my health. So, you might be willing to pay a surgeon more, or you might be willing to wait more, which is time. Time equals money. So, and the reference price effect, basically, like here we have Wendy's versus Dairy Queen, and everybody has little ins and outs about both of them, but they're pretty similar. So. Some pricing mistakes. And here we have a quote from George Washington. He came up with this quote way back when. The person who does not calculate time as money will forever miscalculate. That's kind of what we talked about a second ago. Time is money. Time is always money. It's money to your consumer. It's money to you as a business owner. So some of the pricing mistakes is competing on price alone. Basically, it's real tough to compete on price alone. Lots of times the customer is looking at the quality of the product as well. They're looking at customer service. There's a lot of things other than price that they're looking at. Weak inventory or distribution controls. This is another common mistake. I don't know how many times that I've said I'm very upset with this company because I go to buy something and they're like, well, we don't have it at that price. We'll have it in like 2 weeks. I get very upset about that. Inadequate systems for tracking competitors' selling price and market share. If the customer down the road is doing a $10 coupon and I'm not aware of that, and all of a sudden I'm selling something for $100 and he's selling something for $100, but he's offering like a $10 coupon, I need to be aware that he is selling his product for $90. This might be the same product, and customers are going to perceive that differently. So you need to be aware of that. That's another common mistake.
So what price matching is used to try to,
yeah,
get that information in?
Right. Price matching is used to try to handle that situation. Cost up pricing, price inconsistencies. You may go to the store and say, well, last week I bought it for $5, now you have it for $10. It's like, do you want to go back there? Paying sales representatives on dollar volume rather than additions to profitability measures. And we use an example like performance bonuses. I happen to like bonuses, like selling commissions, because it helps motivate your selling staff. It goes back to the HR problem that we talked about earlier. Are they a theory X type person or are they a theory Y type person? Well, if they're a theory Y type person and they sell on commissions, they know that the more they sell, the more they're going to make. If they're a theory X kind of person where they're kind of like unmotivated and lazy and they work on commissions, you can say, well, you're not going to reach your sales goal this month, so we're not going to pay you as much. And it motivates them to try to sell as much as they possibly can. Next, we're going to talk about discounts and allowances. And everything here is kind of like a selling tool. Discounts and allowances are often introduced into pricing strategy to attract more orders and gain customer brand loyalty. Examples are early payments You pay only the principal and you save on the interest. I know a guy who just shopped that way. He likes the fact that he's only paying the principal, and if he pays it in 6 months, he doesn't have to pay any interest. Off-season promotions. How many people have gone to the store and bought stuff off-season? You buy a bathing suit in December because it's 50% off. It's a lot cheaper. You're like, well, I'll just wait till like June when I can wear it. So people buy in bulk. There's discounts for people that buy in bulk, and examples here like Sam's and Costco. I go to Sam's sometimes and I buy stuff and it's a lot more than I'm ever going to use, but geez, I can't help myself because it's so much cheaper. So retail discounts, an example is buy one, get one free. They also have cash discounts, and here we have like 2, 10, net 30. And I know some people get confused about what those numbers mean. Basically, it means here that if you pay me what you owe me in 10 days, I will let you take a 2% discount. But everything that you owe me is due in 30 days no matter what. So that's what 210 net 30 means. And you also have trade-ins, like, everybody's traded in a car. Some people trade in their boats and get another boat, things like that. So just in summary, we understand the essentials of setting prices. We determine the right approach for your business. And we limited pricing mistakes common to small businesses. All right, this next module, we're going to talk about reading financial statements in basic accounting. Our objectives are to understand basic principles of accounting and to learn about the structures and elements of the income statement, profit and loss statement, the balance sheet, and the cash flow statement. The accounting principle, there's basically two ways that people look at accounting, or there's two ways that you can collect. There's the cash basis, and this includes when you receive cash and when cash is paid out. And a lot of this is for small businesses. The other way that people do it is they do accrual-based accounting, and they deal with when profit is earned and when expenses are incurred. And the big difference here is, like we said, it's like if you're on the cash basis and you mow a lawn, as soon as you get done with the lawn, the consumer may give you $20. You're going to write down, I made $20 today. Expenses when they're paid, you fill your lawnmower up with gas. A week later, I paid $20 in gas. When accrual accounting, what you're going to look at is I mowed a lawn today, so I've earned it, whether the customer pays me right now or pays me in a week, but I earned it, so you're going to record it as being earned. And expenses are incurred. You bought your gas on a credit card and you did not pay the cash that day for the gas, but you incurred the expense, so you're going to write down, I spent $20 for the gas today. Those are the two differences. The basic financial statements are the income statement, the balance sheet, and the statement of cash flows. Basically, the income statement, and what it does say is earnings and costs for a business over a period of time. And it's real important that you understand the income statement is for a period of time. So, and we'll talk a little bit more about the balance sheet, which is for a snapshot. It covers time. What it doesn't say, do you have enough money to run your business? That's not what the income statement will tell you. Do you have enough equipment or too much debt on your business? The income statement won't tell you that. Why it's important? Only way to tell the business is making or losing money. Basically, the income statement does cover the day-to-day operations of the business. How it can be used? It can be used to determine if operations are profitable, and it can be used to identify strengths and weaknesses. How does it relate to the other financial statements? Basically, the income statement is just a piece of the puzzle. All the financial statements are linked in one way or another through net income, depreciation, amortization, payroll taxes, and expenses. The income statement, which is also known as a profit and loss statement, talks about revenues, income, and sales. And this is going to be basically at the top of your income statement. Some examples are sales revenues, interest income, service income, commissions, things like that. The next is going to be your cost of goods sold. And usually this is a direct selling cost for the product. And when I mean direct, it means that you can, like, say, the reason this is the cost associated with this product. If I sell 10 of them, this is the cost associated with 10 pieces of product. Your operating expenses is also known as your indirect cost. And they're associated with services consumed in the process of operating your business. Examples are wage expense, rent, utilities, supplies, repair and maintenance, stuff that you're going to do every day. Basically, your income statement is a summary of the revenue and expenses for a specific period of time, such as a month or a year. And then lots of times what we'll do, especially when you're starting out to do financing, we'll do a profit and loss or income statement for every month that you're in business. And here you can see at the very top of the income statement is the revenues. And you're going to take all your revenues, and then you're going to minus your cost of goods sold, and that's going to equal your gross profit margin. This is the profit before expenses, at everyday expenses, like rent, insurance, utilities, things like that. You're going to take those expenses away, and basically it's going to come out with your operating income or your net expenses. This is another view of the income statement. You can see here the revenues. He has two revenue streams. He has wings, and he also has drinks. And you add them together, and it comes out to total revenues. We'll take year one, total revenues of $100,000. Cost of goods sold. This is the cost it is for the product, is $45,000 for the wings, $5,000 for the drinks. So you add those together. His total cost of goods sold is $50,000. Now you basically take your total revenue minus your total cost of goods sold, and that equals your gross profit, which here in this case is $50,000. Next, you're going to take your operating expenses. And this is, once again, like your everyday expenses. What's your advertising, what's your rent, what's your utilities, things like that. And you're going to come down with earnings from operations. And that's $10,000. You're now going to take stuff from your balance sheet, your depreciation, your amortization, your loan interest, and take that away from your operating income. And that's going to give you a net income for the month. In this case, it's $8,000. Some of the ratios that you can gather from the income statement is a sales growth ratio, which is basically sales on year 2 minus the sales from year 1 divided by the sales from year 1. Another thing you can look at is the gross profit margin. And this is your gross profit divided by your sales. And sales and revenue are pretty much the same thing. So it's going to be your gross profit, your $50,000 divided by your $100,000. You also need to look at your operating profit margin. And that is your operating profit minus your sales. And if you go down and you see earnings from operations, that's $10,000. divided by your sales of $100,000 equals 10%. Your net profit margin is going to be your net profit divided by your sales. And basically your net profit is the same as your net income. So it's $8,000 divided by $100,000 comes out to your net profit margin being 8%. Are there any questions? Business variations, different in how businesses account for for sales, account for cost of goods sold, which is your direct cost, account for operating expenses, which is your indirect costs, set taxes and accounting policies, and set the legal structure. And we talked about that with the sole proprietorship, the partnership, the corporation being double taxation, and your limited liability company. And this is just an example of the different ways to calculate cost of goods sold. A restaurant, for example, is going to take their beginning inventory plus their purchases plus their freight costs minus ending inventory. That's going to equal their cost of goods sold. A manufacturing company is going to be a little bit different. And a manufacturing company is going to take their material costs plus their direct labor plus their equipment and space leased plus their supplies and utilities. And that's going to equal their cost of goods sold. And basically for services, there is no real cost of goods sold. There's only operating expenses. This is just an example of some of the operating expenses, how they differ between different types of organizations. For daycare, you're going to look at advertising, association fees, auto expenses, bank fees, insurance, meals, payroll, supplies, telephone, utilities, things like that. For a restaurant, you're going to have advertising again. You're going to have equipment insurance. You're going to have lease of a building. You're going to have life insurance. You're going to have payroll. You have professional fees. You have supplies. You have telephone and utilities. For a manufacturing company, chances are you're going to have advertising. You're going to have cleaning supplies. You're going to have insurance. You might have rent. You're going to have office supplies. You're going to have payroll. You're going to have telephone, utilities, things like that. So some of these are very similar between different types of organizations. You know, they pretty much all advertise. I had a question. I've always wondered, why does 3M advertise? I mean, how many of us actually are go buy 3M products? We see it, but we're not the person that's buying it. But there is a customer out there for 3M. So, right here, the income statements look different for different businesses, and we kind of like talk about this. You don't want to compare apples to oranges. Which format should you use? It's highly recommended that you talk to an accountant and find out what type of format you should use. What type of accounting software to use, QuickBooks, Peachtree, etc. Those are the two main ones, but there's other ones out there. So do your research with the IRS, know what you're going to get taxed on, know what your tax basis will be, and speak with a Vboc advisor. And at the bottom is comparisons useful within the same industry and similar sized companies. So if you are selling electronic equipment, you don't want to compare yourself to somebody who's producing oranges, right? And at the same time, if you're an electronic company like Best Buy and you're a local electronics store, you don't want to compare your local electronics store to Best Buy, because Best Buy is a national chain. It's all over the place. So their sales are going to be quite different than yours are. Their customers are going to be quite different than yours are. Next, we're going to talk about the break-even point analysis. The break-even point is a point at which cost or expenses and revenue are equal. Basically, there is no net loss or gain. The break-even point equals fixed cost minus unit contribution margin. And I'll get more into what a unit contribution margin is. Another way is fixed costs divided by unit selling price minus its variable cost. Break-even sales in dollars is fixed cost divided by 1 minus variable cost divided by sales. I told you we'd talk a little bit about the contribution margin. The contribution margin is the amount remaining from sales revenue after all variable expenses has been deducted. So basically your contribution margin would be what's left after you take your revenue minus your cost of goods sold, or all your direct costs. And that's going to give you how much profit you're going to make. It's also how much do you have to contribute back. And the break-even point is going to be taking that number. Let's say you sell your product for $1 and it costs you 70 cents to cost of goods sold to make the product. Then your contribution margin is or gross profit is also going to be the 30 cents, right? Now let's say that it takes you $300, that you have $300 in operating expenses every month. Now you need to know that it's going to take, how many of that 30 cents is it going to take to do the $300 to cover your $300 cost. How many units do you have to sell in order to break even? That's your break even point. Here, your sales revenue minus your variable cost, which is like your cost of goods sold, equals your contribution margin ratio. You can also do this for sales. So it works the same way. Next, we're going to talk about the balance sheet. What does the balance sheet say? Where value lies in the business? Who has claims on what the business owns? Is your business overextended? What it doesn't say, if your business is profitable, your balance sheet doesn't cover your day-to-day operations. That is going to be your income statement. Why is it important? Need to make sure you can meet future obligations of your business to see if you have invested enough in the right places. And these are all things that the balance sheet will not tell you. So what is the balance sheet? The balance sheet is a financial snapshot taken at a point of time of all the assets the company owns and all the claims against those assets. So remember, the income statement covers a period, and the balance sheet is a snapshot. It's just a point in time of what the business is doing. Basically, the balance sheet is broken up into assets, and assets are resources that the business owns. Here it says owners have legal title to assets which can provide benefit now and in the future. That's kind of the definition of an asset. If you own a store and you sell something on consignment, then you don't hold legal title to that product, so it's not an asset of yours. Current assets can be converted into cash in a short period of time. This is usually within a year or less. Fixed assets are physical items owned by the business. Goes back into property, plant, and equipment. And the other type of asset is other assets, and mostly they're non-physical items like deposits, licenses, intellectual property, goodwill. things like that. Like if your company owns a patent, it may be another asset. Also on the balance sheet are liabilities, and a liability is a debt owed by the business. Examples are accounts payable, notes payable, wages payable, etc., stuff like that. A creditor is a person that you owe. A supplier is a person that you bought product from to make your own products. And current liabilities are like accounts payable, notes payable, loans, leases. Basically, current liabilities are the same as current assets, except this is money that you owe, and it's usually within a year. Equity is the ownership interest in the business. And just to give you a brief example, capital, how much money did you invest into the company? Common stock, is it a corporation? How much stock do you own? And stock can be broken down into common stock and preferred stock. Bonds, how much does the company owe in bonds? And retained earnings. So this is kind of the basic equation of the balance sheet. And let's say you're asking yourself a question like, well, what's net worth? The net worth is what the company owns, its assets, versus what the company owes, its liabilities. So you can see at the bottom, equity equals assets minus liabilities. This is a snapshot of a balance sheet. And you can see there on the left, it has assets, and the assets are divided into current assets, fixed assets, and other assets, with the total assets at the bottom. And that's compared to liabilities. You have the current liabilities, long-term liabilities, and you add those together, and then you have stock owners' equity. And so if you look on both sides, the total assets are $139,709, and the total liabilities and equity is $139,709. This is why they call it a balance sheet. Basically, your assets need to equal your liabilities plus your owner's equity. And that's why it's the balance. The next statement that you need to know is the cash flow statement. What does it say? It says how cash flows in and out of your business, sources of cash, where it is spent. What it doesn't say, if you're spending your money in the right places, it won't tell you that. Why it's important, businesses need to generate positive cash flows to stay afloat. Cash flow and working capital. Working capital is needed by the business to pay suppliers and other creditors, pay expenses and employee wages, and allow for customers who are allowed to buy now but pay later. This is something that we kind of like discussed about how, you allow that you have to buy supplies and you sell the supplies, but you sell them on credit and you're not going to see the money till later. So working capital, you have to have enough money to keep yourself in operations until that person pays you back for the products they bought. So it's important to remember that cash is king. Believe it or not, the world rotates on cash, so that's a big thing. So what is cash flow? It's how much money comes into your business and how much goes out. Cash does not necessarily equal profit. So cash is a reality check. You can be profitable, but if you don't have cash coming in, you may not be in business much longer. So measuring cash flow, there are two measures of cash. There's the accrual basis and the cash basis, and we kind of went over those at the beginning. Accrual basis, you sell on credit. You look at it when it's earned, not when it's pay to you, and you look at expenses when they're expense, not when you pay them. So cash inflows and outflows. Sources of cash are events leading into inflows of cash. Some of the examples of inflows are getting a loan, selling an asset, selling product, things like that. Uses of cash are events leading to outflows of cash, maybe buying an asset, paying out a loan. Why is the cash flow important? It reports where a company gets its cash. Is it getting its cash from revenue? That's good. Is it getting its cash from owner investment? That could be so-so. Is it getting its cash from a loan? You know, so it's important to know where it's getting its cash from. How a company uses the cash during the period. Basically, the cash flow statement is another one of those. It looks at a period, and it looks to see, well, how's the company using the cash? Is it going out as an investment? Is it going out as a financing activity? You know, is it going out as operating? Things like that. Basically, if you look on the right here is an example of a cash flow statement. And the cash flow statement is broken down into operating activities, which is basically your day-to-day activities for operations. It talks about your investing activities. And what this is, examples of this is like purchasing an asset or buying equipment. And financing activities, which is like using a credit card, getting a loan, things like that. So the cash flow statement is broken down into those three categories. And they each kind of tell a story. Usually most of your operating activities deal with, like you said, your operations, your current assets, and your current liabilities. Your investment activities pretty much deal with your long-term assets, and your financing activities deal with your long-term liabilities and also your owner's equity. So, and if you look at the very bottom, it adds all those up together, and it shows that the cash at the end of the period is $36,422. So just to go over that, so for operating activities, you made $14,422. There's no investing activity, so you didn't buy any assets here. Financing activities, payment of a note is minus $3,000, so you pay down $3,000 of money that you borrowed. So you look at your net cash in is $11,422. Your cash at your beginning of your period was $25,000. So you add those together, and it comes to the cash at the end of the period. How much cash do you have? Is $36,422. This kind of goes back into the financial gap I was telling you about and why you need working capital. If you look at this chart, basically your inventory turnover, it's where you buy inventory, where you pay for inventory, and then you sell it. But there's a gap between when you pay for inventory, when you make a sale, and when you collect for that sale. And that creates a financial gap. And you have to have money to cover that area. Knowing the cash flow. Remember what I said before, cash is king, because no cash means no business. Improve cash position by analyzing cash flow. Identify the inflows and outflows of your cash. Use the cash flow statement as a measure of performance. Use the working capital cycle to identify the financial gap so that you know that you may need extra money. An example of this is, let's say that you have a very seasonal business and that you know that you're going to be busy during the spring and you're going to be busy during the summer. But during the winter, you don't have hardly any business. You need to make sure you have enough working capital so that you stay in business that whole winter season. and you may have to borrow money. There's different ways to get money. Maybe you've saved it over the spring and summer time. So, just in summary, each statement provides a different perspective. Remember, the income statement is more your day-to-day operations. Your balance sheet is pretty much a snapshot of how the company's doing, what the company owns, what it owes, what the owner owns. The cash flow statement kind of tells you where's the cash going out, where's it coming in, to have enough cash to last the cycle. One type of statement is not sufficient to form a solid opinion. Basically, you need all three of the statements so that you can look at it to know what's really going on with the company. Review all statements to form a better picture of the health of the business. Are there any questions? Okay, this last module for today, we're going to talk about financial analysis and benchmarking. We've already talked about the accounting, the importance of the statements, the income statement, the balance sheet, and the cash flow statement. So today, on the financial analysis, we're going to do financial analysis in the process of evaluating financials information for making decisions. We're going to talk about the firm level, evaluate the historic performance of the business, and we're going to talk about the industry level, where we're going to compare your business with another business, or business A with business B. Income statement analysis, why it's important? It's important because if the business is doing well or poorly, you need to know that. You need to know how a lender judged the business. Usually the lender will look at the income statement to decide, well, are you making money or not making money? What methods to use to identify strengths and weaknesses? Okay, how to form a comparison. Changes over time, the same business. Basically, you want to compare your income statement from January to February, month to month, seasonally. Year to year, how did you do in year one versus year two? Annual growth. The same month, but a different year. How did you do in January of year one versus January of year two? You need to know that. Compare, see what the percentage of growth is. Another way to compare is performance versus industry average. And this kind of goes back into the RMA book. And it talks about industry averages. And we go back into comparing apples to oranges or oranges to oranges. You want to look for a business that's similar size. You don't want to compare somebody like a Best Buy to a local electronics store, because the sales are different. Their assets are so much different. Their advertising budget's so much bigger. But another way to compare is by location. Is it national? Is it both companies in the United States? Is it regional? Are both companies in the Southwest? Is it state? Are they all in Texas? Are they local? Or are they all in one city or one metro area?
Or are they web-based?
Right. Are they web-based? Okay, so what is measured? Sales are measured. Costs are measured. Profit is measured. It goes into sales. We talked about gross sales, net sales. You can compare all of those. When it comes to cost, you might want to compare your cost of goods sold, your operating expenses, your wages. We talked about how each of those is kind of like segmented into each group. Profit, you might want to look at gross profit, which is your revenue minus your cost of goods sold. You might want to look at your net profit, which is your revenue minus all your expenses. Basically, so how are you doing January of year one compared to January of year two? This is another copy of the income statement and the ratios that you want to look at. And it goes back in like the income statement is divided into revenues, cost of goods sold, your profit margin, your operating expenses, your earnings from operations, less some of your accounts from your balance sheet comes out to your net income. What you can learn from it is your sales growth. Year 2 sales minus year 1 sales divided by year 1. How much did the company grow in year 2 compared to year 1? Gross profit margin. It's gross profit divided by sales. And this kind of tells you how much money do you have that's your gross profit. What's your contribution margin? Here it's 65% and 67%. Your net profit margin is your net profit divided by your sales. Here it's 6%. And a lot of those you can go down and you can look compared to the income statement to the left, and your sales growth is going to be 100,000 or 110,000 your year 2 minus your year 1, which is 100,000, which is going to equal 10,000 divided by your year 1 sales, which is 100,000, equals 10%. So basically, your company grew 10% in sales from year 1 to year 2. Your gross profit margin is your gross profit, which is 64,700 divided by your sales, which is your 100,000, equals 65%. So basically, you're making 65% of whatever you sell.
Should that stay fairly consistent?
That should stay fairly consistent. There's reasons why it wouldn't, but it should stay fairly consistent as long as you don't add or subtract one of your revenue streams. So, your operating profit margin is basically your 66,700 divided by your sales, which is 100,000, which is going to come out to 6.7, but we're going to round it up to 7 just to be on the safe side. Your net profit margin is going to be your 6,000 at your very bottom, your net income or net profit divided by your sales revenue, which is 100,000, which is equal to 6%. And so you kind of want to see your net profit margin grow. So, because that means that you're selling more stuff from year 1 to year 2.
The one I saw that's impressive there is, can you go back? If you look at year 1 revenues of 100,000 and year 3 at 121,000, he's got a 20% increase in gross sales, but you look down at the net profit, he's got 3 times the profit.
Right.
6% to 18%. That means he's getting more efficient in what he's doing. He's the economy of scale, buying, a product at a better price and stuff like that. And that's the way you want it to be.
Right. Yeah, if you were to compare the year 1 ratios to the year 3 ratios, he's definitely becoming more efficient with the net profit margin increasing and the sales growth staying pretty steady. So here you can see the income statement ratios break down into different segments. The restaurant, the retail segment, manufacturing and services. And you can see how each one of them, their net sales stay the same. Their cost of goods sold changes depending on what type of organization it is. And therefore, their gross profit is going to change because gross profit is going to be your net sales minus your cost of goods sold. You can see how the operating expenses have changed. Restaurant is 60%. Retail store is only 34%. So you can see how the expenses that they charge are different. Their operating profit is different. You can see services are quite a bit more than the other 3 types of organizations. And you can see the net profit at the bottom. So you can see, and don't benchmark yourself off of these ratios. This is just an example. Here is another way that you can compare the two. This goes back to the income statement that we had at the beginning. Basically, his revenue streams are his wings and his drinks, his cost of goods sold, his profit, gross profit, his operating expenses, what's his operating income, what other costs he has, and what his net income is. And you can see that they compare year 1 to year 2 to just year 1 and year 2. And at the far right, it shows the percentage of change. Well, actually, it shows the dollar change. So you can see from year 1 to year 2, he made an extra $8,000. So how to use this information that we talked about? Cost analysis, best deals on supplies. Like was stated earlier, maybe this is the reason why he's operating more efficient. Maybe he's found a supplier that supplies his stuff a little cheaper. Maybe the overhead's too high. Is there too many or enough employees? Identify ways of improving profitability by reducing costs. Maybe he's found a way to do it more efficiently. Product analysis, product type versus by gross sales, gross profit margin, focus on a high margin items, measure growth, decline over time, and seasonality. Set inventory levels to maximize sales. These are all ways that we can use this information, the different ratios. Next, we're going to look at the balance sheet. Basically for the same company, the wing joint. You can see that his assets are divided into current assets, fixed assets, and other assets. His liabilities are on the right. It's broken down into current liabilities, long-term liabilities, and stockholders' equity. You can see that they equal. So the one ratio that we want to look at is accounts receivable days. And to do this, we take accounts receivable minus net sales times 365 days, because 365 days are how many days are in a year. So here we're going to take his accounts receivable, which is $5,000, divided by his net sales that we get from the income statement, $100,000, times 365 equals 18.25. This indicates how many average days it takes for him to collect his credit sales, his accounts receivable. Accounts receivable turnover, it's a little bit different than the ratio. Here, it takes net sales divided by accounts receivable equals how many days. So here we're going to take 100,000 divided by 5,000 equals 20. And 20 indicates the number of times, how many times out of the year the accounts receivable was collected. So the other one was days, and this one's how many times. As you can see here, a high accounts receivable turnover ratio indicates a tight credit policy, meaning that you're only giving credit to people that you know are going to pay you back. A low or declining accounts receivable ratio indicates a collection problem, part of which may be due to bad debts. So you're basically giving credit to people who are not creditworthy. So these are ways to use the accounts receivable turnover. People look at your inventory cycle. Your inventory days are going to be your inventory divided by your cost of goods sold by 365 days. So here your inventory is $5,000 your cost of goods sold, which is a income statement account, is $35,300 times 365 days equals 51.70. And so the 51.70 indicates the average number of days it takes to sell the inventory. So this is the inventory turnover. Basically, it's the cost of goods sold divided by the inventory. So here we're going to take the cost of goods sold, $35,300, divided by the inventory, which is $5,000, and it's going to equal 7.06. So here, if you look at sales, which is 100,000, the inventory is turning over 7.6 times. That's how many times it is a year. So a higher turnover means that the business is able to operate with a smaller investment in inventory. So basically, a lot of people sit on inventory, which is not a good thing. And inventory is an asset, but it's just, if you're not selling it, it's just money that's there that could be making you money. It's not making you any money. Days accounts payable. This is a liability thing. So what we do for accounts payable, the days, is take accounts payable divided by the cost of goods sold minus depreciation times 365 days. Here we're going to take 3,000 divided by 35,300 minus 281 times 365 days is going to equal 31.27. So basically the 31.27 is how many days it takes for him to pay his debt. The fixed asset turnover, remember fixed assets are your property, plant, and equipment. And here you're going to do the turnover, it's going to be net sales divided by fixed assets. So here your net sales were $100,000 divided by your fixed assets, which is $21,303, equals 4.69. And that means the fixed assets turn over 4.69 times to generate sales of $100,000. Basically here, you can see the note at the bottom. Note how well the business utilizes fixed assets. For each dollar of fixed assets, it helps the business generate $4.69 in assets, in sales. Okay? It's another way to look at it. This is the asset turnover, and asset turnover equals net sales divided by total assets. So you're going to take your net sales of $100,000 divided by your total assets, which is $139,709, which equals 0.72. So for each asset, for each dollar invested in assets, it returns 72 cents in sales. In other words, assets turn over 0.72 times as fast as sales. This next one is your current ratio. Your current ratio is your current assets minus your current liabilities. Remember, your current assets are things that can be made into cash usually within a year. Your current liabilities are liabilities that you're going to pay within a year. Here, your current assets are $46,422 divided by your current liabilities, which is $18,000, which equals 2.58. So basically what it's saying is the business has $2.58 in assets and current assets for every $1 of current debt. Here the industry average is 0.7. So if you compare what the industry does, at 0.7 they make 70 cents for every dollar of debt. Here you're doing much better making $2.58 for every dollar of debt. That's what the current ratio will tell you. The quick ratio, this is basically just like the current ratio, except that you're going to take inventory out of your current assets. Inventory is one of your current assets. So your quick ratio is your current assets minus your inventory divided by your current liabilities. And your current assets, $46,422 minus your inventory, which is $5,000, divided by your current liabilities, which is $18,000, equals 2.31. And basically this ratio reveals that only $2.30 of each current asset is available to meet $1 of current debt.
Is that just an indicator of whether you're healthy or not?
Yes. It's an indicator of whether you can meet your current liabilities. So let's say if this number is below 1, or below, like a negative number, it could say, well, I owe 30 cents for every dollar of debt. So basically, if that all my debts got called due right now, I would not, even if I sold everything, I would not have enough money to cover all my debts. It's a bad thing. That's when you're underwater. That's when you're hurting. So here, like we'll show, like the industry average is 40 cents. The wing joint above the average is $2.30. So you can see that it's doing much better than the industry average.
Is that statement, the industry average is 0.4? Is that saying that the average in his industry, the average business has 40 cents to pay every dollar of debt?
Kind of, yes. What it's saying is that basically the company has
I mean, if I read those numbers
right.
right, if he's 2.3,
yeah, if it's below 1,
it's below 1, it means they got 40 cents
right,
to pay every dollar of debt.
right.
If it's below $1.90, he's under.
Well, if it's below $1, he's under. If it's over,
you would hope it would be 1.0, right?
Actually, the higher the better.
Yeah.
So if a company doesn't need to borrow a whole lot of money and doesn't have a whole lot of debt, then it could be anywhere 10 to 1, which would be much better. Means you got $10 for every $1 of debt. And this is current assets and current liabilities. This is stuff that's going to come due right now. If it came due right now. So, and this might mean that the industry average, they need to borrow money, to have more cash. Maybe they're in a low point. Working capital, we kind of talked about working capital and that you need to have working capital to go through any kind of financial gap that you have. Working capital is basically current assets minus current liabilities. And here the current assets are $46,422 minus $18,000. So the working capital that they have is $28,422. This is basically saying that if they were to pay off all their debt, that they have money left over. So all their current debt. Now the long-term debt might be something different. There's a totally different ratio for that. So examining cash flow. This goes back to the cash flow statement. And it goes back to the operating activities, stuff that you're like day-to-day. Investing activities, what you're going to buy as far as plant, equipment, things like that, property. And financing activities, loans, things like that, owner's injection into the business, things like that. So, and these are things that you need to look at as far as the cash flow statement. Cash flow drivers, accounts receivable days. You need to look at that. How many days does it take until you collect? Inventory days. How many days does it take that you're going to till you turn over all your inventory? Accounts payable days. Sales growth, gross profit, operating profit. These are things that people are the bank is going to look at when they consider a loan. Drivers of cash flow. We kind of went over sales growth, and the definitions, the difference in sales from the current year versus the previous year. Gross profit margin, operating profit, accounts receivable days, inventory days, accounts payable days. So you can see the difference between year 1 and year 2. You need to know your cash flow. Remember, cash is king, because no cash means no business. So you can't really operate on credit. You want to improve your cash position by analyzing your cash flow. You want to identify the inflows and outflows of cash. What's coming in, what's going out. Use the cash flow statement as a measure of performance. Remember, it's basically performance. It's not your day-to-day operations. Use the working capital cycle to identify the financial gap. Basically, we talked about the financial gap between when you pay the supplier and when you get paid for selling the product. Working capital, remember, it equals total current assets minus total current liabilities. We just got through talking about that formula. So, and by current assets, we mean due within a year. It's very liquid. Current liabilities, they're usually due within a year. They can come due immediately. Additional assistance, remember that the financial statements are very industry and company specific. Remember, the Vboc counselor will be able to provide you assistance and information, but be sure to discuss your financial statements with your business accountant. We know how to read them. We know the different ratios that people look at, things like that. It's very important, though, that you understand every company is a little bit different. So it's important that you bring your financial statements or your financial projections so that we can look at them and we can ask you questions on where you plan on going with the business.